What's up guys, welcome back to the Daily Stock Picks. And in this video, we will be finding out whether Intel stock is a buy right now, according to this article by Investors Place. So what I'll be doing for you guys is I'll be reading over this article with my beautiful voice, commenting, and we'll be conducting my own quantitative analyses to see whether Intel either belongs in our dividend portfolio or our value portfolio by using this checklist. So before we head on and find out all the intricacies, details of Intel, make sure that you smash the like button for the YouTube algorithm. I would really appreciate it. Hope this video brings you a lot of value because I'm actually trying to save your guys' time and do the quantitative analysis for you so that you can get started doing your research before you invest your money in the Intel stock. So without further ado, let's get this video started. So Intel's buyback is brilliant given its cheap valuation. Intel stock will eventually move higher given the buybacks since it allows the dividend per share to rise, by Mark R. Haig, CFA. So Intel, ticker symbol INTC management, knows its stock price is deeply undervalued as they just announced an accelerated buyback program on August 19. Intel stock will benefit from this buyback program since it represents a significant return of capital to shareholders. So Intel did take a small plunge because of its recent competitor AMD, because it's been releasing chipsets after chipsets for the normal consumer, which are like a really bang for the buck, right, when compared to Intel's processors. And Apple did cut ties with Intel as well. Going to cut ties basically because they're moving towards a more ARM processors. So for example, year to date, the stock is down over 17% and over the past year, it is just up 4.5%. By contrast, the Nasdaq 100 Technology Sector Index, ticker symbol NDXT, is up 45% over the past year and up 21% year to date. So Intel stock has done a lot worse than the average of the top 100 technology stocks. Moreover, the stock is cheap on a price to earnings basis. It trades for just 10.2 times its expected 2020 $4.85 per share earnings per share by the average 20 analysts polled by Seeking Alpha. Moreover, Morningstar says its past 5-year price to earnings ratio average is 15 times the earnings. This means Intel stock is at least 33% undervalued. Put another way, the stock has the potential to rise 50% from 10 times the earnings to 15x. So Intel can afford the accelerated buyback. Intel said it would buy back $10 billion of its own common stock between now and the end of 2020. At today's price, that amounts to about 202.9 million shares. It already has agreements for 166 million shares, or 81.8% of the expected total. More importantly, $10 billion represents about 4.76% of its $210 billion market capitalization. The way this helps shareholders is mainly through dividend increases. For example, with 5% fewer shares outstanding, the company can afford to increase its dividends per share by 5% every year now at the same cost as before. So for example, over 10 years, this brings in 50% more real income to shareholders at no higher cost. That in turn will lead to a higher stock price since the same dividend yield as before the stock would rise by 5%. So again, this could lead to a 50% stock price increase over 10 years. Therefore, in effect, it doubles the value to shareholders over 10 years. Moreover, Intel can clearly afford this share buyback. In Q2, the company made $7.75 billion in free cash flows to pay for dividends, which only cost just $1.4 billion. So we can see that the dividends are pretty covered here, according to what the writer is saying. So going forward, the company has $6.35 billion to pay for debt reduction and share buybacks. Where this leaves Intel, Intel bought back between $3.5 billion and $4.5 billion in last year. Last quarter, Intel halted its share repurchases. Therefore, the $10 billion buybacks this quarter is only $1 billion to $2 billion more than it would have normally done otherwise over the past 2 quarters. Intel says it will have repurchased 17.6 billion of its 20 billion authorization it announced in October 2019. With this $10 billion buyback, it will complete the remaining 2.4 billion when markets stabilize. There is no indication of what that means or if the company will return to buybacks in fourth quarter. So some analysts on Seeking Alpha think the buybacks are not important given that Intel is falling behind in technology. I'm more on that side as well, to be frank. They specifically refer to the company's 7 nanometer product transition delayed versus prior expectations. Others think it is a strong signal. However, Jefferies analyst Mark Lipakis was more brutal. According to Seeking Alpha, as he said, its 7 nanometer transistors would be delayed, followed is 10 nanometer transistor delays, and leads us to believe its transistor challenges are systematic and that TSMC and AMD's transistors lead will extend. What to do with Intel stock? I believe that this is a brilliant move by Intel as it gets its technology back on track. Taking advantage of the weakness in the Intel stock through share repurchases will increase shareholders' value. Assuming the company's repurchase up to 5% of its equity every year for 5 years will allow the dividends to rise by 25% at a higher cost to the company, at no higher cost to the company. Moreover, it also allows the company to post higher earnings per share at the same level at net income. Patient value investors will probably be well off to take advantage of this weakness in the stock. The buyback catalyst will help the stock eventually move higher. So as of this writing, Mark Hake, CFA, does not hold a position in any of the aforementioned securities. He runs the total yield value guide, which you can review here. Okay. Now let's have a look at Intel stock to see if it either belongs in our dividend portfolio or our value portfolio based on its current price. So just by looking at the price to earnings multiple, we can see that Intel stock INTC price to earnings multiple is 9.28, which is on a heavy, like a nearly, I would say 66% discount when compared to 66% cheaper when compared to the entire S&P 500 index. So which is on, seems to be on a fire sale. Now, in order for a company to meet my dividend portfolio, it basically needs to meet my 4 rules. And these 4 rules are based on books that I've read. The first book is Dividends Still Don't Lie by Kelly Wright. They run their own investment quality trends platform, which is purely based on dividends. And Get Rich with Dividends by Mark. And the third book is The Ultimate Dividend Playbook by Josh Peters by Morningstar. And the 4 rules or the 4 principles goes as follows. The rule number 1 is that the current free cash flow must be positive. So we want to be making sure that the company is in actuality is bringing in cash opposed to showing cash on the income statement as its net income. And rule number 2 is that dividends paid out should be more than 75% of the current free cash flows. So we want to be making sure that 25%, at least minimum 25% of the free cash flows are retained by the management so that they can reinvest it back into the business in order to grow its top line and bottom lines. And rule number 3 is that we're looking for really good dividend companies here, right? So we want to be looking for companies that have at least grown their dividends over the past 5 years. If you want to be more on the conservative side, I would recommend looking at companies that have been paying dividends and increasing its dividends over the past 10 years. And rule number 4 is our buy criteria. So we only want to be buying the stock when the current dividend yield is greater than or equal to the 5-year dividend yield average, right? Now let's have a look. So I like to use White charts because they do a really good representation of the financial information in a visual aspect. I like to look at visual things rather than looking at boring old numbers. So we can see that Intel has been paying out its dividends. And the free cash flows are positive. And we need to make sure that the dividend that's being paid out should not be more than 75%. So 5.576 divided by 16.93. That equates to around 32% of its free cash flows. The remaining 67% can be reinvested back into the business by the management if they choose to do so. Now let's see how consistently Intel has been growing its dividends. So according to Seeking Alpha, we can see that Intel has been increasing. It has been paying out dividends since 1993, but it's only been increasing its dividends over the past 6 years at a rate of somewhere around 6.96%. So that just basically means that it's growing the dividends at a rate of 6.96 compounding annual growth rate for the past 6 years. So it definitely meets the criteria because it is paying dividends over the past 5 years and it has been increasing them. Now let's see if it's the right time to buy the stock. Now typing in Intel Corporation, it's just loading. We can see that the current dividend yield is 2.59%. And we can see that the average dividend yield is 2.62%. So it's just around 3%. It is really close. I wouldn't hold back because it is some near the average. It's just off by a 0.2% or 0.3. 60, 61, 60, around like 0.03%. So I would recommend buying this stock as a dividend portfolio because it has been at its all-time highs. So just as a matter of fact, or just for fun, let's have a look when the previous peak was. It was around March of this year when the dividend yield was around 2.78. If you were to look at this in terms of the dividend yield theory, we can see that from March of this year to the peaks, we can see that it has nearly $45, a half. I would say it nearly returned around 40 to 50% in a span of 2 to 3 months. But it did take a dip because of the analyst expectations and AMD literally destroying Intel and Apple also cutting its ties because it's moving towards an ARM processor base, right? But rest assured, I would still recommend buying Intel because it's really close. And now let's see if the Intel stock does meet our value proposition as well. So in order for a company to meet my value portfolio, it needs to meet 5 rules. These 5 rules are based on books that I've read. The first book is called The New Buffettology by Mary Buffett and David Clark. Mary Buffett used to be the daughter-in-law of the world famous Warren Buffett, the Oracle of Omaha. And the second book is Rule Number 1 by Phil Town. And the third book is The Little Book That Still Beats the Stock Market by Joel Greenblatt. A wonderful book to read about his magic formula that he calls it. In the value portfolio, these are the 5 rules. So the rule number 1 is that the return on invested capital should be more than 10%. So return on invested capital just shows us how profitable the company is. The higher this number, the better the company is in terms of its cash flows and in its profitability. And rule number 2 is we need to make sure that it has consistent net cash flows. And rule number 3 is that it needs to have a strong balance sheet. So the long-term debt on the balance sheet, it should be able to clear it off, or the company should be able to clear it off within 6 years or less. And rule number 4 and rule number 5 are our buy criteria. So we will only be buying the stock when the current price is lesser than or equal to 80% of the fair price. We'll be calculating the fair price a little bit later. And the rule number 5 is that if rule number 4 isn't met, we can consider buying the stock if the current price to earnings multiple is less than 50% of its all-time highs over a span of 5 years, and it is cheaper than the S&P 500 index, right? Now, looking at the fundamentals of Intel corporations, we can see that the return on invested capital is greater than 10%, so definitely a good one. The free cash flows have been increasing, so the free cash flows haven't doubled that much, maybe around 5 to 8% year over year growth. And the dividends, they've been increasing the dividends over the past 6 years, as we've seen previously. So net cash flow is pretty consistent. Now the balance sheet element part of it, The total long-term debt is around $38 billion and the total current assets is $44 billion. So current assets are the line items in the balance sheet which can be liquidated into cash within a span of 12 months. So these are the most liquid assets on the balance sheet statement under the asset section. So if the management chooses to do so, they can clear off its long-term debt instantaneously. So literally the clearance time is 0 if the management chooses to do so. Now let's see if the company does me trading at a discount at the moment. So 5.43. Oh yeah, sorry, I forgot to include this one. So Intel stock price. So Google Finance. Surprise. And this definitely belongs in our dividend portfolio. Now we know the earnings per share is $5.43. Now let's see the basic price to earnings multiple range. It has been trading over this past 5 years. We can see that it's 8.790, 26.51. So it is definitely at a 50% discount, but more on that later. Now Intel corporations. So analysts are estimating that the company should be growing at 8.62. So whenever we're looking at the company, we want to be making sure that we're being more conservative, because even if you're wrong, we're at least protected by the downside, right? So what we're doing here is we're taking this earnings per share 10 years into the future by multiplying with this particular growth rate, and we need to be multiplying it with the multiple, right? We need to know what the price to earnings ratio would be 10 years from now. In order for us to do that, we can either consider the analyst estimates multiplied by 2, or we can consider the average of the price to earnings ratio. If you were to consider the analyst estimate, which was 8.62, you'll be getting the multiplication ratio of 17.24. So that is the price to earnings multiple that we'll be using for this calculation. So the intrinsic value of the company is $197.03. That is the stock price that would show up 10 years from now if the projections hold true. And the fair price is we're bringing this price back to the present day, considering a 15% acceptable return year over year. We should be buying the stock out of somewhere around $56. And we never want to be paying the price at sticker price. We want to be paying at least a 50% discount on that. And the way that we would be looking for is we want to be looking when the company is at least at 80% at a markdown. So if you were to look at this, we should be considered buying this company when it's somewhere around $44.81. Current valuations are putting the company at $50.43 as its current price. So it does seem to be expensive on the higher side when compared to rule number 4. And comparing to rule number 5, it definitely does meet the criteria. So the 50% of the highest price to earnings multiple would be 26.51 divided by 2, 13.255. And the current price to earnings ratio is less than that. So the first criteria is met, and it is definitely lesser than the S&P 500 index. So it does belong in our value portfolio under rule number 5. Value portfolio, rule number 5. So Intel corporations, depending upon the way that you look at it, we did use basically 3 types of analysis. One is by the dividend, and one is by a pure intrinsic value calculation, and one is by a price to earnings multiple. I would recommend buying the stock at this current price. It does seems to have a little bit of upside potential that's going for Intel, because most of the Intel businesses, I think it does do like large scale server farms and everything like that. They tend to go with Intel. Prior to that, AMD wasn't that dominant, but AMD has putting more efforts into the consumer side, part of the chip market. And if you guys have stayed around till this part of the video, I really appreciate it. Thank you so much. And full disclosure, guys, This video is for your education and your entertainment purposes only. There is no guarantee that you'll earn any money using the techniques and the ideas mentioned in this video. This is not financial advice. Please consult your financial or tax professional prior to making an investment in these companies. So if you guys really like this video, make sure that you smash the subscribe button and turn on the bell notification icon so that you can get notified as soon as we post new videos. And until next time, peace.